often these webinars are very heavily attended. And if you ask a question, it's possible that there wasn't enough time for your question to be addressed. There's usually either only one or a few different moderators in the background that are there answering questions, and usually they're not able to provide a specific answer. If there's, for example, 500 questions that are asked, that's not out of the ordinary in some of those webinars. So these are usually smaller sessions, fewer people, and we're way better at kind of addressing questions. So what we're going to do here, I'll go ahead, just share a couple quick disclosures, and then I'll start off before we jump into the questions. I'll do a very quick, just round robin of where things are. Here are some resources. I think that's going to answer probably a lot of the general questions, and then we'll take a little bit of a deeper dive into some of the specific questions. Now, again, because even though this session is, we have an hour kind of marked off, please ask your questions as soon as possible so that we can get to them. If you wait for the last 5 minutes and then start asking a ton of questions, we're likely not going to get to it. Unfortunately, we do have some clients that do that sometimes, and then they're upset. Hey, you didn't get to my question. We had a full hour. Try to ask your question earlier in the session. We're more likely to get to it. Don't wait till the last 5 minutes and then ask your question right as we're closing up. We're just not going to have time to answer it. So I'm going to pivot over now that we've shown disclosures. I'm going to go to fidelity.com, and I'm going to show you a couple different places to start. So the first place to start for general kind of what is an ETF, ETF versus mutual fund questions. Let's do this. Let's go to news and research. Let's go down to where it says learn. This is the Learning Center. On the left-hand side, you'll see some of our content in the events. So encourage you to check that out. Shameless plug, Trading Strategy Desk coaching and classes. But let's go here. Let's click on the topics and then investment products. Again, topics, investment products. Let's go over to ETFs. And again, what this is going to do is this is going to give you a lot of different articles, resources. And again, a lot of the questions tend to be kind of general questions about how do I know if an ETF is right for me? What are some things I need to know about an ETF? What are pros and cons? ETF versus mutual funds. This is a huge topic. Everybody asks, what are the big differences? And so we don't want to spend kind of a great deal of time on that because they're more, again, of those general questions. If you scroll down further, there's more articles, the basics, inside ETFs, benefits, risks to consider, different types of ETFs. I would say a lot of ETFs were kind of born out of the desire for trading index. So index ETFs, I think, are probably amongst the most prolific or the most popular. More recently, there's been kind of a push and kind of a resurgence of actively managed ETFs. And I'll be honest, to me, I get the idea of having the desire to enter market orders during daily lows or highs, but kind of think about the thought process of an active product. If you're investing in an active product, the idea is you're seeking the value of active management. There's a cost, there's a value. The cost of an ETF that tracks an index is often very, very low because that's all it does. It tracks an index, right? The risk is maybe it has bad tracking error. You want to look at its tracking methodology. If it pursues what's called a direct indexing method, or it uses some kind of derivative process, maybe it uses a system of futures or options. So sometimes there can be other risks to consider there. There's different types of bond ETFs. So there's stock, there's fixed income ETFs. Certain ETFs function a little bit differently. For example, a lot of stock indices tend to be market cap weighted, whereas a lot of bond indices tend to be debt weighted. And you got to be a little cautious with that. And so, like, for example, if you have a company that issues in a large cap sector that issues more outstanding debt and has a large issuance, if you're invested in a bond index, you could actually have more exposure to a company that has a larger amount of debt and is actually at a little bit of a higher risk before it actually drops out of the index. Whereas with something like a stock market cap index, it often makes you kind of keep buying the winners. And sometimes there can be a lot of narrow focus towards the top. So just from a general perspective, there tends to be a little bit of a difference of a gap in terms of the value of the active management in the bond space versus in the stock space. So I'm not going to go too much into that. There are some questions, again, not going to spend a great deal of time either. Things like inverse or leveraged ETFs. A very quick kind of general perspective is these tend to be very short-term trading vehicles. They typically will say aims to daily track XYZ or two times XYZ index. They could be good if you want to just kind of have a simple one instrument. I buy and then I sell. But again, you have to be cautious because often these instruments will have, and they will even say outright that they don't aim to have a longer term type of a correlation. So if you're looking to invest in something, often these might not be the best tools to do that. So again, news and research, learn, left-hand side here, topics, investment products, ETFs. It will give you a lot of that general information. The next thing I'll do is what we talked about a couple different things, or Albert and Peter talked about a few different things. There were some questions about the ETF screener tool. How do I get there? What kind of screens can I use? What kind of methodology can I see within the ETF? So that's going to be found if you go to News and Research, down to where it says ETFs. And then from there, you'll see if you scroll down here, here's that link to the ETF screener. It's right there. It's prominently displayed. You could click on really any of these little links. They're kind of shortcuts, or you could simply just click on Launch Screener Tool. There's also a big button here that says Screener Tools. And you'll see in addition to the ETF screener, there's other screeners for different types of funds. We're going to talk about and focus just on ETFs today. But once you have the screener launched, you'll see on the left-hand side, there's a whole host of different criteria we can use to filter out maybe include certain favorable characteristics that we like. Maybe we want to filter out certain undesirable characteristics. We can say maybe we want to see just Fidelity ETFs if we're curious. Hey, what does Fidelity offer? BlackRock from iShares, or iShares by BlackRock, is very popular. They're, I believe, the most popular suppliers of ETFs. We could seek ETFs by a certain market cap, by a sector. Maybe we have some kind of ESG desired exposure or covenant of some kind. But let's go to just Fidelity ETFs. And then it's going to say, do you want to see all of them? Do you want to see Fidelity ETFs that are thematic, like robotics, AI? Do you want to see actively managed ETFs, factor ETFs? Let's just click all of them. Fidelity definitely has quite a bit, and you can see we actually have a list of 71 different funds. So maybe if you said, hey, from the get-go, I want to stick with something I know and I'm familiar with, a Fidelity product, maybe we want to do that, and then we could filter further. Maybe you want to use iShares and then filter from there. You could do it with actually a number of different ETF providers. There's actually a filter tool that I believe is Investment Sponsor. Let me see if I can find that here. Of course, you can never find it when you want it right immediately. But I believe there's another different sponsor we can look at, and you could actually, that might actually be in the mutual fund screener, that you can pick a specific company if you have a specific company in mind. But again, you could start with kind of broad-based and then kind of start to narrow down. I find that that's the kind of the most logical way to find an ETF using a tool like the ETF screener. Again, just make sure that if you want to, again, usually the first kind of screener that goes, depending if you add some other screeners, is it'll usually kick out a lot of those leveraged or inverse ETFs. Approach those with caution just because they tend to have certain risks. But if we're excluding those, there's something like 3,000 plus ETFs that you can choose from. So there's a big universe. Just make sure you are aware of what criteria you're using. Make sure it fits what you're looking for. Sometimes there can be funds that don't quite fit exactly your filtering criteria. So be aware that If there's, hey, I want an ETF that has an average expense ratio. If your expense ratio is 0.01 higher than what you want it to be or less, it'll exclude it. So just, keep in mind some of those ideas that a lot of these filters are hard filters. And even if something almost fits a screener, you might want to loosen up some of that criteria if you're not getting a really good number of results. So it's a very powerful tool. We can also go to our portfolio page and maybe think about, if I have a blend or a portfolio of different ETFs, how much exposure do I have to to the stocks, to bonds, to certain sectors? So there's other tools that can help us not only find ETFs, but kind of diagnose what's our current mix and does that meet kind of our desired mix, for example. So let me take a pause there. That's just a very kind of quick, kind of initial foray. We can also go into, when we click into a specific ETF, we can then take a deeper dive into that ETF's specifics. We can think of what are its top holdings, what's the stated objectives of the fund, what's its expense ratio, and we can look at all those specifics. We can also, there's a comparison tool that can help us kind of compare it and look at a number of criteria and say, how is, for example, SPY different than IVV or VOO? Well, one is a Spider S&P 500 ETF. One is iShares S&P ETF. One is a Vanguard S&P ETF. 500 ETF. So you'll want to look at the specifics and see, is there slightly different indexing methodologies? But spoiler alert, they're going to be probably very similar type of funds. So again, let me pause there. Jake, I know we've got a couple of folks that just simmered in terms of seeing our attendance numbers go up a little bit. Were there any questions maybe that stuck out to you or any ideas that you want to kind of start us off by sharing?
There is, yeah. Thanks, Troy. Welcome, everybody. Thanks for being here. We're going to spend the duration of the time answering your questions. So there's already a dozen plus questions in the hopper. We'll do our best to work our way through them, but don't be shy. Send in any questions you have. There's a little over 100 people in the audience, so not everybody's asking questions, and a few of you asking more than once. So great, send them in. We'd love to hear your questions. We'll do our best to answer them. While you're here on the stock screener, you've already made some customizations. Troy, one question was coming from, let's see, Neil was wondering, once you've done that, how can you save this? Folks, over there in the top left-hand corner, do you see where the mouse was hovering? Save to my screens. If you'll click on that for us, Troy, it gives you the chance to just type in whatever name you'd like. We could type in ETF webinar or something like it. Screen, great. Once we type in whatever title is meaningful to us, we hit save, and then it is indeed saved, and we can come back to this future. Click on the top right-hand corner. You still have to navigate to the stock screener, but then click on My Screens up there in the top right, and here we have the ones that we've created. So this is where you would have those filled in based on whatever you've saved in the past. Great question. Thank you for asking, Neil. I find that hugely valuable. Let's go ahead and start working through these questions here. The first one came from A is the first name. A, you're wondering about ETFs that could be worthwhile in a falling rate environment. As soon as we start talking about rates, my assumption is that we are thinking about funds in the rate world. We're looking at bond-related funds. If you would want to look at stock funds in a falling rate environment, that could be an entirely separate discussion. But the discussion for bond-related ideas is actually fairly simple as soon as you understand just a few key characteristics. Let's go ahead and take a look at that ETF screener. And I'm going to focus in on those that are of the asset class of, let's look at bonds specifically here in the United States. And taxable bonds is what we're looking for. So here under the taxable bond category, we've got all sorts of funds that exist. Some of them are focused on specifically treasury related, so US government bonds. Others are corporate related. Some just say that they are the aggregate bond. There's many different funds out here that do so. But if we come over and take a look at a few different ideas, when we scroll over to the basic facts, we'll see some of the details about the fund. We could read up on it and understand its expense ratio, for example. They do vary widely, 0.03% for the aggregate bond index AGG, 0.55 meanwhile for CEW. Under income characteristics, it will tell us how often it's paying out a dividend. And that will certainly be of interest when we are thinking about a falling interest rate environment. And I'll circle back to this here in just a moment. But if we come over here to this page, the performance and risk for a bond-related fund, one of the characteristics we want to take a look at, and maybe it's actually showing up in a different area. Let me take a look. There we go. Fixed income weighted average duration in years. So in the world of fixed income and bond investing, duration is not a measurement of time, but it's a calculated value related to the average portfolio weight in the portfolio. So if you owned only bonds with a 10-year till maturity time frame, your duration would be a little bit less than 10 years because it is going to take into account the payment of the interest over time, but it would be something like 10 years if you had only 10-year bonds. So it does have to do with the years, and that's how they're measured. But the higher the number tells us where this weights out over time. So this one over here, this 24 duration, tells us this one has much longer time frame bonds in there. This is important, Gilmer, because we have a falling interest rate assumption in your question. When an interest rate changes by 1%, the bond or bond fund will change by this percent, by the duration in percent. So if long-term bonds moved up by 1%, this fund would see a decrease of 25% in value. Meanwhile, if long-term bonds interest rates were to drop by 1%, you would see a 24% increase in the value of this fund as a result of that change. So this is a substantial value. When you're looking at then which ones would be good for falling interest rate environments, first make sure you consider what interest rate you are talking about. Are you only talking about short-term interest rates going down? That's the one that the Fed controls, and we're likely to hear more about tomorrow from Jerome Powell. If the short-term interest rates come down, that will change our value, but also as we take a look at the duration, we'll understand how much variability is likely to show up in respect to those. So great question. I hope that's at least a starter in how you would start that analysis. Second question, this one comes in relation to an attempt to get access to something like SPY. SPY is the fund that tracks the S&P 500, one of the heaviest traded securities out there in the world. But naturally, it's exposed to all 500 plus companies in the S&P 500. But if you're looking for one, as your question implies, that focuses not on those top 10, but instead on the remaining 490, well, there's not a ETF that I'm aware of that does exactly what you're talking about, but there are a few ways to accomplish this. Many of them are going to include more advanced versions of investing or trading known as a long-short portfolio, where you're going to buy something and sell short something else to get the net effect between them. That could be complicated to both set up and also to manage if you're not familiar with the intricacies. And it does require a margin account, which not all traders have. So be aware that yes, this can be done, and there are many ways for you to accomplish it. But in order to do what you are looking at and get more exposure focused in on the other companies, I might suggest that you take a look at funds that are equal weighted. Equal weighted funds is what you might look for. And there you could find an opportunity to do so. For example, if we just type equal weight up here in the top, oops, have to spell it right. Equal weight, we'll find all sorts of funds that focus on this equal weighted idea. In this case, depending on which area we are looking at, which type of fund. But when you do, you'll see that you've got that equal weight opportunity. There are equal weighted funds for the S&P 500. That's going to mean out of every stock in there, they're all going to be allocated the same approximately 2% or so of the portfolio, or 0.2% of the portfolio, so that they're equal in exposure. That will limit the exposure to the larger ones and focus greater on the smaller. Otherwise, you're going to have to do that long short portfolio. Next question was related to dividend ETFs and which ones might be good in relation to interest rates dropping as a result of a change. When you clarify in your question that you say that it's because of a soft landing instead of a recession, I'll point out that odds are pretty good that the effect for these would be similar in regards to the interest rate drop alone. So if we focus on the interest rate portion, that will have an effect. But then if we think about the recessionary aspect, then that would differ as well. So if we're going to go ahead and focus in on funds that are going to do well, given the dividend payout ratio and soft landing, likely since you're under the impression that a soft landing is in the cards, you're willing to have at least some exposure to the equity markets. A recession would hit equities harder than they would fixed income. So you're likely to include, if not focus on equity-based ETFs. And then finding the best dividend ETF is really about understanding the health of those companies. Be aware that any focus on a dividend payout is a little bit short-sighted. We need to recognize that a company who pays a dividend is doing so taking money out of their bank account and handing it to you, leaving the company with less money to pay their bills, pay their employees, do research, develop products, buy inventory, market the products to the public, and then turn that product into additional profits for you. So be aware that they are saying that they want to return this money to you as opposed to reinvest in the business in some other way. That doesn't always mean a positive. In the past, Troy, you and I have talked about this at length. In the past, folks, say 50 years ago, if a company could afford to pay a dividend and to increase its dividend each and every year for many, many years historically, that was also a healthy company that was strong and likely to continue to exist. In the modern investing world, dividend payouts are not viewed as a necessity. Companies may or may not choose to pay a dividend whether or not they can afford it. There are 3 companies currently worth over $3 trillion a piece right now, and not a single one of them pays a dividend that's anything remarkable. So please note that investing on the sole basis of dividends is focusing on outdated information and focus instead on the total return. Let's think about how are we earning over the course of our investing lifespan. We don't care whether that comes in terms of dividends or in terms of capital appreciation. So long as you own the stock long term over a year, then the dividend or the capital gain tax ratios are effectively equivalent, and you've got a very, very similar scenario. So do your best to try and limit the overly focused view on dividends. Let me hit one more question here, Troy, lightning fashion, and then I'll pass it over to you. Nancy, you're wondering, is there a way to eliminate certain columns on the ETF screener so you only get what you want printed out? First off, I'll tell you, now that you know about the stock screen saving functionality right up here, I rarely am going to push the print results. You do have the ability to print it, but be aware that that's what you're looking at. Each of the columns that you have added over here on the side as criteria can be removed. And so if I come over and you say the leveraged part isn't particularly interesting to you, well, this is one that unfortunately is going to be there regardless, whether you've checked boxes or not, but I didn't choose to add this. Meanwhile, down here, when I had previously added in here asset class, I've got this X on the side, and I can go ahead and remove that. However, if you are interested in printing off the list, Nancy, but you don't want all of them, you don't want to waste all the ink, what I would encourage you to do is to download the results into Excel. I can do that by just clicking this. It will ask us which of the pages here we would like to include. I'll just do the search criteria for now. It will download this. I'll open it up in Excel really quickly for you. And then all you need to do is make whatever customizations you would like in Excel prior to printing, or maybe you just keep it in a digital fashion to save the trees based on your own preference. You don't want the leveraged information. You can right click up here at the column header, hit delete, and there we go. That's gone. And now you can print or save as you like with only the information you're interested in. So downloading probably going to be your go-to for that one, Nancy. All right, Troy, any other questions standing out to you? Quite a few in the hopper. Thank you, everybody, for the active question asking.
Yeah, we get these type of questions a lot, Jake, about taxes. And, full disclosure, we're not tax advisors, so we can't give you tax advice. And we certainly encourage you to seek tax advice if you need that. But I always like to give informational, educational info about taxes. A lot of people, when they talk about ETFs, will talk about, hey, there tends to be lower turnover. And again, if there's an index-based ETF, maybe it can have fewer kind of capital gain distributions, which could be favorable if you're planning on holding something in a longer term, and as opposed to maybe a fund that has a lot of turnover, it has a large distribution. And sometimes, even if you're holding the fund, you can have short and long-term gains, which, in a taxable account for some people could be undesirable. So here's a question. The question was, if I had a traditional IRA buying an ETF and selling it, does that result in any taxes? And then for mutual funds, what about those? I'll be honest, myself, I do a lot of my trading in a Roth IRA, which is similar to a traditional IRA. There's different types. With an IRA, it's an individual retirement account. How they typically work is you're not taxed when you move around investments of any kind. There's a few exceptions. If you do something like a limited partnership or like a K1, Jake, if you want to chime in on that, I think you've probably seen a couple instances where that happens. But for the most part, generally investments, when you buy and sell within an IRA, it's a tax advantaged account. You could be traditional, it could be Roth, but the idea is there's only potentially a taxable event when you take money out of the IRA. So if you're dealing with a taxable account, right, like an individual brokerage account, your TOD, your joint TOD, whatever you'd like to call it, or whatever it's named, when you buy and sell investments, it results in a capital gain or loss. There's short term, there's long term. And so you have to kind of think about that where investors, it's typically more advantageous to hold something longer than a year. If you're in a tax advantage account, holding period becomes less important. If you're still a longer term investor and your investment's doing well, hey, continue to hold it. But the idea is the turnover of investments is less important. It's more about the total return is more of an important aspect. Hopefully that helps. Jake, any kind of thoughts there?
Yeah, I agree with you, Troy. Folks inside of an IRA, don't be too concerned with taxes in general. The ones that you mentioned, Troy, that can be concerning are things that happen to be a limited partnership.
Yeah.
Schedule K1s usually are still not going to have to get filed within your IRA, but folks, we're not tax advisors. Talk to a qualified tax advisor if you want the details on a full view here. Dave says he'd like some details on a specific group of ETFs. They are Fidelity ETFs, and you're hoping to compare them against a few of the mutual funds and things that exist. I think that will be beyond the scope for most of the people in the class, but you are certainly welcome to call in for that, Dave, and one of our traders can walk you through some of the comparisons between them, looking at them. But you did point out something interesting and worth pointing out that I'm going to share with the class here as a whole. You had found that on any number of funds like this one, if we go ahead and take a look at it, under the description, we're going to find that almost any ETF that you look like under this profile area is going to say something like this. The advisor normally invests at least 80% of the fund's assets in equity securities of companies with large market capitalizations, or they'll say of the components of the index or something like that. So what's happening here? What we need to remember is that the advisor has some rules, and the rules are set out in the prospectus. Basically, it says, this is how you should invest my money. Then the manager is supposed to go out and follow those rules and to get the money invested. Ideally, that results in positive investment returns. But in some cases, the fund advisor can't even choose good investments. They must choose these investments. For example, a fund like the S&P 500 ETF SPY that we talked about a moment ago. That fund manager can't choose good investments. The fund manager can only choose S&P 500 investments, and specifically must have those in proportion to what lines up with the S&P 500 index. So they can't make any other changes or decisions. Rather, they're working with those decisions. But funds that have a little more discretion will often have this saying something like 80% of the fund's assets. And then what's happening with the rest of it? Well, part has to do with money going into or out of the fund. If you buy $100 million, let's pretend we're all rich. We had $100 million and you wanted to dump it into this fund today. It might be that there's not $100 million worth of sellers interested in parting with these shares today. As a result, Fidelity would newly mint you brand new shares of the Fidelity Fundamental Large Cap ETF, and those dollars would go into the fund, and the fund manager would get them invested. But this 80% clause, this gives them some wiggle room. You are not forcing the fund manager to invest all of those dollars into the underlying securities at that very moment. They do have some timing discretion. You might think about it. Also, dividends will accumulate within the fund. As a result, then they end up getting paid out to you either on a monthly or quarterly or sometimes annual basis. Those are not required to be reinvested into the capital because you've got some leeway here. So you might think of it almost like a little bit of slush fund availability that they can adjust the strategy within. So regardless of which fund you are looking at, you will find characteristics like that for any fund there. Stephen, you asked how to see the portfolio page. There's a few different portfolio pages. If you're looking at a specific ETF like I am here by typing in the symbol or searching for its name in the top right-hand corner, you can come here to composition and you'll find the composition of that specific ETF's portfolio. You would find that in the case of this one, it holds these holdings currently in the portfolio with these weights as of the most recent update. And if you click down on here under view all holdings by weight, indeed, it's just this big, huge, long list of the proportional holdings of the entire portfolio. So you get a whole lot of detail, or you can look at it by region. There's some other ways for you to dive through and take a look at these overall. But the big focus is understanding the portfolio of the given ETF. If you're instead wanting to know how to find your own portfolio in your Fidelity account, which of course is also a possibility, click on Accounts and Trade, and Portfolio is the top link where you'll be brought to see this home page. This is what most people see the first time they log into their page. So hopefully that helps, Stephen. All right. Next one, let's go ahead and take a look at, Andrew, you were wondering if we could zoom in for better clarity. That's a great tip. I'll zoom in a little bit more. I don't remember if I was speaking or Troy when that was brought up, but thanks for the thought. Mike, you asked, can you discuss the baby version of these ETFs for those who may want to enter with relatively small accounts? All right, let's pretend we're not $100 million investors. Now we're $100 investors. No problem. ETFs are actually one easy way for you to get access to the markets in a simple way. Let's suppose you wanted to be invested in Apple and Nvidia and Microsoft and all of these big companies, let's say the S&P 500. Well, in order to buy one share of each of those completely would cost you several $1,000s. Apple's a couple hundred a piece, Nvidia a couple hundred a piece, Microsoft a couple hundred a piece. But these days you can actually buy even fractions of a share. So supposing that you wanted to buy some share of Apple, you could do so by just typing in the symbol and you say you want to buy. But instead of choosing a quantity, which is saying the number of shares in whole numbers, you would come here to this little calculator and say, oh, I want to buy $100 worth. Even though the price is 200 a piece, well, now we're going to end up with a fractional share quantity. And that's allowed, and that's a recent advent to the stock investing world. So you can buy individual stocks that way, But you also can do the same with an ETF. So SPY, the fund that we've mentioned a couple times related to the S&P 500, is currently trading for over $500 per share. So again, if you wanted to buy $100 worth, all you need to do is type in the number here, and you can buy that share quantity with just $100 to start off. So you can do that with any amount. I think the smallest amount it'll let you do is something like $5. So very, very affordable. There isn't a cost to do this so long as you place the trade online. No commissions is what I mean with that. And so you can kind of get in and get out at your leisure. This also helps you get some exposure with relatively small amounts. So those are some great opportunities and ways for you to get started, whether using large or small, but you can buy in and sell out of them, Mike, in the same way as you would even if you had thousands or hundreds of thousands of dollars. So great question. Aida, you were wondering about the performance and risk page there, and you were wondering if we could go over it. I'm going to assume that you were asking that based upon the stock screener, but clarify for me if that was not the case. That performance and risk page on our ETFs, let's say we want to look at, again, some of these bond-related funds. When we look at the performance and risk tab here, it's got a whole bunch of characteristics, some that might make sense to you right off the bat and some that don't. Market total return means how much did the price of the security go up and any dividends that they paid out during that time frame. So it's going to account for price and any paid out dividends or distributions is what we call them from an ETF. Those all make sense, year to date, 1 year, 3 year, 5 year. Then we start getting into some numbers that put you into either a advanced finance class or a statistics class at minimum. So let me just break these down quickly. Standard deviation tells you how far away from average we have been. If we say that this AGG fund has earned almost 0.18% per year for the last 5 years, how much has it deviated from there? Up or down 7% is how you would read this. Sharpe ratio has to do with a risk-adjusted return, knowing how the return went and how big the swings were up or down. We're looking for the highest possible positive number would be the best Sharpe ratio. Beta tells us how something relates to a given index or security, in this case, related against the Barclays aggregate bond index. The R2 tells you when you look at the beta, how much does that explain of the overall security's value, and finally tracking error. So again, if these seemed foreign to you, they're new terms. One opportunity is for you to go ahead and click over here on the definition, and you will find that it's got a breakdown for each one of those, and you could read up on it. For example, if we wanted to scroll down and find the one for beta, it will tell us this relative valuation and how it changes. If that doesn't seem to quite meet it for you, then I would encourage you instead to go ahead and make use of the fancy AI that everybody's talking about. Go Google it, search it, use ChatGPT, whatever you would like to get a more detailed explanation, because they can break those down for you in very easy to understand ways. All right, a couple other ideas. This one is a fascinating question. Are ETFs insured? Are ETFs insured? ETFs are not insured against loss. If you were to buy any investment, bonds, stocks, options, you name it, it can and may lose value. They are not insured against loss. In fact, guaranteeing against loss is a prohibited criminal activity because it's simply not true. You are taking risk. That's in fact why you expect to make your return, is because of the risk you are taking. Are they insured in other ways? Let's suppose I have bought this in my Fidelity account and then Fidelity goes belly up. What happens to my shares? Well, crossing my fingers that that never occurs. But nonetheless, if it were to occur, then your holdings are insured by what's called the SIPC, the Security and Investor Protectors Corporation, which insures deposits sort of like the way that the FDIC insures banks. If the bank goes belly up, you get your bank account back up to the amount of the FDIC insurance. In a broker world, it's a little different because, again, you are not guaranteed against loss. So it's not the specific dollar value, but it'd be the value of the securities on the day the company went belly up. If Fidelity had gone into your individual account and stolen the securities, there's a lot of ifs in this scenario. Then instead of getting those back, you would receive value back to you based upon the amount of the value missing from your portfolio. So in short, yes, they're insured, but only in a very weird way. And it's basically against broker fraud is what you're being insured against in terms of SIPC. If you have more questions on that, again, follow the last recommendation to dive a little deeper into it. Finally, there are a couple other guarantees associated with some of these. For example, if you were to buy into a bond fund like this one here, TLT happens to be a fund that invests exclusively in the treasury bonds. The underlying investments inside of a fund may have some guarantee associated with them. In the case of treasury bonds, the guarantee is the full faith and credit of the United States government backs this bond. As a result, if the bond fails, it would be because the US government failed to pay its debts. While the debts are ever mounting and are huge quantities, so far we have never fully defaulted on a bond payment. And so the likelihood of that occurring is very low, but they are guaranteed only by the promise to pay of the issuer. In some cases, like the US government, that's probably a pretty safe bet. But if you were holding a bond with the guaranteed promise to pay by the full faith and credit of Blockbuster, it probably didn't go so well when they stopped having full faith or credit and the ability to pay those debts. So weigh that always against the value of the promise being offered. I'll answer one more here and then I'll pass it back to you again here, Troy. Jay, you said, is there a way to find which are all the ETFs bought by Fidelity account holders, similar to how you see which stocks are going on? Looking at the Fidelity ones alone, I don't recall a resource that shows us specifically that, but if we come over here to the ETF research page, we'll see a few things that are related. For example, this very first one right here tells us the most percent move securities. This is not for Fidelity traders. This is in the market as a whole. So it's going to take a look and say, all right, for US equity funds, so stock funds based in the United States, how are they doing, up, down, or sideways, and which funds they are that are doing that. Or if we go ahead and change this over, we could take a look at today's top high prints or losers today. We can look at any sorted variety. In addition, we can also look for another idea. Specifically, we can come here to the stock screener, the ETF screener, and instead of looking at a given asset class, we can look at the volume today, and we can see those that have the greatest volume traded, which is the number of shares traded today or any given day. And sorting that by a list, we'll find that NVD is the ETF that currently has the most shares traded today, 24.2 million. However, please notice the market price of those shares is $1 a piece. The next one on the list is 17 million, still a lot of shares, but now each one of those shares represents $559 a piece. 559 times 17 million is a much larger number than $1 times 24 million. $24 million. Here we're talking about billions of dollars trading hands. So be aware that there certainly is some value in weighting that volume based on the share price. But there's a few ways for you to take a look at some of those that are going up or down. But no, Jay, it doesn't have that nice breakdown like we do on the stocks of how many buy or sell orders are being done at any given time like we do for stock trade. That's a fun visual anytime you look at it. All right, over to you, Troy.
Yeah, I think there was a few questions. I'll go ahead, just grab the screen. If you go back to our ETF page, again, news and research, and if we go down to ETFs, of course, there's a link to the ETF screener. There were a couple questions about how do I know if a certain stock is in an ETF? Of course, we could click on that specific ETF and look at its composition. But if we're instead kind of doing it the other way around, where I want to find an ETF that has certain stocks, there is a tool like this where we can type in a few different ticker symbols. For example, Apple. I'm going to do Coca-Cola, McDonald's, and Microsoft. And I'm going to go ahead and view. Maybe we have to separate them by list here. Let me just do one. You have to click them. Okay, here we go. Coca-Cola. I'm going to add Apple. I'm just random companies that come to my mind. No methodology used at all here. So I'm just clicking these. We can hit view matching ETFs. And again, we'll hit a list. If you pick a lot of different companies that are very different in their style, you might get some kind of odd results where you get, we got a couple different stocks that were kind of these looks like they're leveraged short-term trading. There actually was a Fidelity fund, which is an information technology fund. It has a large exposure to Apple. It also has a large exposure to Microsoft, but it actually doesn't have any exposure to McDonald's. And that should probably not come as a surprise, just due to their kind of different companies, there. If we take a look here, um, for example, this one towards the bottom has a little bit more of an equal weighted or a little bit of an exposure to each. So that might be something that we could look at as well. So that's a cool tool that you can use and you can kind of play with a little bit. There was a question or two that says, hey, I have very basic needs. I just want a tool or some way where I can build a 60/40 portfolio or do something. Well, there's a tool right here. We don't give it a lot of time. It's kind of, again, when you're building a portfolio, you have to decide, am I self-directed or do I need to work with an advisor? If you're somebody that's self-directed and you say, I just want a 60/40 portfolio, you can actually use a tool like this and it'll give you an idea of here's some funds that can help you kind of make that portfolio. So if that's all you're looking for, there is a tool that can help you do that. So just wanted to point those out. And then there were a couple questions. Once we have, again, we've used our screener, we found some ETFs of interest. I'm going to click into one of these funds. It looks like it's Fidelity Quality Factor Fund. I'll click into that. There were some questions about what are some of these tabs? What do they really mean? And I think that will basically wrap up a lot of the questions that we saw here, Jake. There was a couple comments that were just thank you, appreciate it, and such. But when you search an ETF, you're going to have a bunch of different tabs. You can look at the chart. This composition tab is going to be very, very helpful because it will spell out what does the fund seek to do. It gives you a blurb on its stated objectives, and then it'll also say what's its philosophy. Often we get the question, how do you know if this ETF is active or it's passively managed? And if you click into it, here's a spot. It will tell you this is actually considered a passively managed fund. Now, this is probably one of those factor funds. So it's kind of like it's a modified index fund. It's usually an index fund with certain rules or certain additional criteria that are added on, but it's not fully active management where portfolio managers have a wide discretion. It's more of a rules-based type of approach. So, for example, it says it seeks to the performance of the Fidelity Quality Factor Index. You have to look up the index, normally investing at least 80% of assets in securities included in the index, which is designed to reflect the performance of large and mid-cap capitalization companies with a higher profile than the broader market. So we have to kind of dig a little deeper to understand what does a higher quality profile look like. Maybe it's meeting certain PE or valuation ratios. Maybe it's looking at certain underlying growth metrics. Maybe it's looking at certain levels of indebtedness. So finding companies that are more quality. Again, you have to kind of dig a little deeper to say, how do you define quality? We could go down here and we could see what are its top 10 holdings, what is its market cap exposure, and you could see it has giant and large, but it also has a little bit of mid cap exposure too. but the giant and large are quite a bigger piece of the pie. If you had to fit it in one of these style maps, right? Value blend growth, large, mid, small, you can see it's going to most resemble a large cap growth portfolio. So that's what it's going to most resemble. And then you can also see geographic exposure. These are North American securities. So this does not have international exposure. So that's not something you really have to worry about. Somebody was asking about this performance and risk tab. I'm not going to spend a lot of time here. And then Jake, maybe we could wrap up. This will show ETFs are designed to most of the time trade in a narrow range around their net asset value. There will be times that it'll fluctuate. For example, this chart here is a percent of the premium or the discount. That means trading above premium, trading at a discount below the net asset value. Now, recall when you trade a mutual fund, you trade the fund at its end of day net asset value. Whereas an ETF, we trade it during the day at the available market price, whatever that is. You can look at the bid and the ask price. For example, this isn't real time, but right as of 12/31/14, so it looks like it's delayed. A delayed quote that you could buy it at 63.40 cents per share, and you could sell it at $63.37 per share. So there's a little bit of a difference there. It's about a 3-cent spread. So you want to think about, okay, am I buying it at a premium or a discount? Um, Funds that trade at a discount to NAV, there could be a reason for that. If they trade at a premium to NAV, there could also be a reason for that as well. But the idea is a good fund usually trades right around the zero bound of its NAV. And you can see here, even the widest, this is, I believe, at a 0.5%, so half of 1% discount to its NAV. And I think the top range here, which it doesn't even get to, is 0.5% of a premium to its NAV. So very, very narrow range. And typically, the more liquid the fund, you'll usually see it be at an even tighter range. It gives you some total return stuff. So it says hypothetically, if you invested $10,000 back in 2016, right? So about 10 years ago or so, or maybe about 8 years ago. I don't think this fund has been around that long. It can give you the total return performance over time. You can see it in a chart format. You can also see it in a table format. And I believe you have to kind of read that there's an asterisk here. It might be assuming that we reinvest dividends, things like that. On a dividend paying fund, those dividends are going to be a bigger component of the fund's total returns compared to a growth fund, which I think this fund is, where it may not pay out a lot of dividends. So that's not going to make a bigger difference on the longer term returns. And even if you say, all right, maybe I paid a premium of NAV, maybe I paid a discount to NAV, you can see over a long period of time, there's not really a wide spread or difference between the market price and the NAV price. And that should be clear. If you bought it at NAV 5 years ago, here's your return, versus if you paid the market price, you got basically about the same return. There's other different types of characteristics. These are more advanced performance characteristics in terms of correlation, volatility, outperformance to a benchmark, adjusted for volatility and things like that. And then there's other different types of return metrics, and of course the expense ratio. So again, we can have a lot of fun with this. There's a lot of tabs. We're not going to have time to go over this. And I saw one last minute question about, again, more general info. What are some of the main differences between an ETF and a mutual fund at the end of the day? What are some of the take home differences that we really should consider? And again, I'll just point this out as we wrap up that ETFs are traded products. We trade them during the day. Is that important to you? Are you an active trader? If you're a longer term investor, trading intraday may not be as important to you. If you're a short term trader, it's likely to be far more important to you. Do you prefer to track or follow an index? Do you prefer to have the value of active management? I'll be honest, if you look, a great deal of active managers don't outperform typically their benchmark. However, I like, and this is something that's kind of
encourage you to join us for some of these. The easiest way to get there is, again, Fidelity's news and research, then learn page, click on events, or I prefer to just type it in right up here at the top, fidelity.com/coaching, fidelity.com/coaching, and that will bring you to that same page we were just looking at where you could find us. It's been my pleasure to share an hour of my time with you. I hope it was worth your while. Until next time, folks, take care. We'll see you soon.